Welcome to Friday morning's episode of Crypto Macro Insights. I'm Maya, and it's Friday, September 12th, 2025, 7 a.m. Eastern. Tom, we're ending this historic week with Bitcoin holding steady at $115,550, marking a remarkable 42.5% gain over 6 months from $81,073. Our reverse repo monitoring shows continued decline to $26.90 billion, down 79.5% from March's $131.06 billion baseline. What's fascinating is the sentiment from internet voices we're tracking. Hard to get excited about these prices when we've spent all year at these levels, perfectly capturing retail fatigue even as we document extraordinary macro conditions. With the VIX at 14.71, down 39.3% in 6 months, and institutional liquidity deployment accelerating. Tom, how do you interpret this disconnect between price performance and public sentiment?
Maya, this disconnect reveals something profound about market psychology at inflection points. Bitcoin's actual performance has been extraordinary, 42.5% gains in 6 months, while traditional risk metrics collapse. The VIX at 14.71 represents maximum institutional risk appetite, and the reverse repo decline to $26.90 billion confirms massive liquidity deployment. Yet internet voices express fatigue with these prices. This is textbook late-cycle psychology. When retail traders become bored with 40% plus gains over 6 months, it signals we're approaching maximum complacency. Maya, this isn't weakness. It's the exact condition institutions need for final accumulation. The comment about spending all year at these levels ignores that we've ranged from $81,000 to $115,000. That's not consolidation. That's a massive uptrend that retail has become numb to.
The numbers are telling a clear story. Bitcoin up 42.5%, reverse repos down 79.5%, VIX down 39.3%. These are not subtle movements, they're dramatic shifts in the financial system. Yet the sentiment seems surprisingly muted. How do we reconcile this?
Maya, this is the classic wealth transfer mechanism in action. Institutions are deploying $104.16 billion in forced liquidity, money that cannot earn 4.3% yields when Fed cuts are imminent. They need retail complacency to complete this deployment without driving prices higher prematurely. The internet fatigue with Bitcoin at $115,000 after a 42.5% run is exactly what institutional flows require. Retail says hard to get excited, while institutions quietly absorb every available share. This isn't market manipulation, it's mathematical inevitability. When you have $26.90 billion in remaining reverse repo funds seeking deployment destinations, and retail traders are bored with historic gains, you create perfect conditions for the next leg higher. Maya, the most dangerous time for retail is when they become comfortable with extraordinary returns.
As we head into the weekend, Bitcoin sits at these elevated levels with this curious mix of strong fundamentals and retail fatigue. What should investors be watching for?
Maya, we're maintaining the disciplined approach we've outlined over the previous episodes. The data confirms our thesis. 42.5% Bitcoin gains, 79.5% reverse repo liquidation, and maximum retail complacency create the perfect setup for continued institutional accumulation. Weekend consolidation around $115,000 would be healthy after such gains. The key insight is that retail fatigue at these levels, expressed as hard to get excited, is exactly what we want to see before the next acceleration phase. Monday's opening will be crucial to watch, especially if institutional flows continue deploying the remaining $26.90 billion. Maya, when retail voices sound bored with 40% plus gains, smart money knows the real move is just beginning.
Remarkable week in summary. Bitcoin closes Friday at $115,550. Up 42.5% in 6 months, while internet sentiment expresses fatigue despite extraordinary performance. Reverse repos continue historic decline to $26.90 billion, down 79.5% since March, representing massive liquidity deployment into risk assets. VIX at 14.71 confirms maximum institutional risk appetite. Key insight: retail boredom with exceptional returns creates perfect conditions for institutional accumulation. As we documented throughout the week, the greatest opportunities often emerge when markets perform brilliantly but participants lose excitement. Monday will reveal whether institutional flows continue deploying the final $26.90 billion in forced liquidity. For crypto macro insights, I'm Maya. Stay disciplined, follow the data, and remember that the most dangerous time in markets is often when everything feels too comfortable.